If you are age 60 or older and you are considering selling your family home, downsizing to a smaller property, or relocating into a retirement community, I need you to drop whatever you are doing right now and listen to every single word of this broadcast. Over the past several decades, home values across the United States have surged to unprecedented historic highs. The house you purchased 20 or 30 years ago for $150,000 might easily be appraised at $650,000 or $750,000 today. While that massive growth in equity represents a wonderful retirement nest egg, it also creates a terrifying financial trap. Millions of senior homeowners who decide to sell are suddenly hit with unexpected, devastating capital gains tax bills from the Internal Revenue Service and state tax authorities, often wiping out $30,000, $50,000, or even $100,000 of their hard-earned home equity in a single closing transaction. But here is the critical financial truth that real estate agents, escrow companies, and local government officials will rarely explain to you in detail. Under Internal Revenue Code Section 121, federal law provides a bulletproof tax exclusion that allows eligible senior homeowners to shield up to $500,000 of home sale profits completely tax-free. Furthermore, by coupling Section 121 with capital improvement basis adjustments and surviving spouse tax provisions, you can legally erase every single dollar of capital gains tax liability, keeping 100% of your profit right where it belongs, in your bank account. Yet, because the IRS does not automatically apply these tax exclusions without proper documentation and reporting on Schedule D and Form 8949, thousands of retirees unknowingly overpay their taxes every single year. Today, we are breaking down the exact multi-step tax protection strategy, the precise capital gains mathematical formulas, the widow and widower tax extensions, and the exact word-for-word scripts you must use when speaking with your CPA, tax preparer, or settlement officer to ensure you pay $0 in unnecessary home sale taxes. Let us begin by addressing the stark mathematical reality of home price inflation and how capital gains taxation works when a senior sells a primary residence. When you sell a property, the IRS looks at your net sale price and compares it against your adjusted cost basis. If your net sale price is higher than your adjusted cost basis, that difference is classified as a capital gain. For retirees, long-term capital gains are subject to federal tax rates of 15% or 20%, depending on your overall taxable income bracket. On top of the standard federal capital gains tax, higher income retirees or those who experience a large one-time home sale gain are hit with the 3.8% net investment income tax, commonly known as NIIT. When you add state capital gains tax rates, which can range anywhere from 5% to over 13% in states like California, New York, or New Jersey, your total tax rate on a home sale gain can easily reach 25 to 35%. Consider what happens without proper tax planning. Imagine a couple, Robert and Susan, who bought their primary home in 1995 for $200,000. Today, at age 67, they decide to sell their home for $750,000 so they can downsize into a single-story home near their grandchildren. That transaction generates a raw gain of $550,000. If Robert and Susan did not understand IRS rules and failed to claim Section 121, a 30% combined federal and state tax rate would subject that gain to an astonishing tax bill of $165,000. Handing over $165,000 to tax authorities destroys a massive portion of the retirement savings they built over a lifetime. This brings us directly to rule number 1, the IRS Section 121 Primary Residence Capital Gains Exclusion. Section 121 of the Internal Revenue Code was explicitly enacted by Congress to allow homeowners to sell their primary home without being penalized by inflation. Under Section 121, if you are a single taxpayer, you can exclude up to $250,000 of capital gains from your taxable income. If you are married filing a joint return, you can exclude up to $500,000 of capital gains from federal income tax. To qualify for the full $250,000 or $500,000 tax exclusion, you must satisfy two fundamental tests established by the IRS, the ownership test and the use test. Under the ownership test, you must have owned the home for at least 2 aggregate years during the 5-year period ending on the date of the sale. Under the use test, you must have lived in the home as your primary principal residence for at least 2 aggregate years, or 730 days, during that same 5-year window. The 2 years do not need to be consecutive, nor do they need to be the final 2 years before the sale. As long as you meet both the ownership and use requirements within the 5-year period, you qualify for the full tax exclusion. Now, let us examine a critical legal protection under Section 121 that thousands of widowed seniors miss: the 2-year surviving spouse exclusion extension. Suppose a husband and wife owned a home jointly, and one spouse passes away. If the surviving spouse decides to sell the family home, do they automatically lose the $500,000 joint exclusion and drop down to the single $250,000 limit? Under federal tax law, as long as the surviving spouse sells the primary residence within 2 full calendar years after the date of the deceased spouse's death, and provided the surviving spouse has not remarried, the IRS legally permits the surviving spouse to claim the full $500,000 capital gains exclusion. This rule saves grieving widows and widowers up to $75,000 or more in federal taxes during an already stressful life transition. Now, let us examine rule number 2, adjusted cost basis adjustments and capital improvement stacking. What happens if you are a single senior homeowner who has lived in your home for 30 years, and your profit on the sale exceeds the single $250,000 exclusion limit? For instance, suppose you bought your home for $150,000 and sell it for $550,000, generating a raw gain of $400,000. Subtracting your $250,000 Section 121 exclusion leaves a remaining taxable gain of $150,000. At a 20% tax rate, you would still owe $30,000 in capital gains tax. This is where capital improvement cost basis tracking legally eliminates the remaining tax bill. Many senior homeowners assume their cost basis is strictly the original purchase price they paid decades ago. That is completely false. Under IRS tax regulations, your cost basis is dynamic. Your adjusted cost basis equals your original purchase price plus the total cost of all capital improvements made to the property over the entire duration of your ownership. What qualifies as a capital improvement? A capital improvement is any permanent addition, upgrade, or restoration that adds substantial value to your home, prolongs its useful life, or adapts it to new uses. This includes replacing the roof, installing a new HVAC heating or air conditioning system, remodeling a kitchen or bathroom, adding a room, installing new windows, upgrading plumbing or electrical systems, building a deck, or installing accessibility modifications like wheelchair ramps or walk-in tubs. Maintenance and cosmetic repairs, such as routine painting or fixing a broken tile, do not count. However, major structural upgrades do. Let us look at the exact mathematical proof of how stacking capital improvements erases taxes. Returning to our single homeowner who bought for $150,000 and sold for $550,000. Suppose over 30 years, they kept receipts for major capital improvements including a $40,000 kitchen remodel, a $20,000 roof replacement, $15,000 for new windows, and $15,000 for an HVAC system, totaling $90,000 in documented upgrades. When you calculate the adjusted cost basis, you add $90,000 of improvements to the original $150,000 purchase price, raising the adjusted cost basis from $150,000 up to $240,000. Now, when you subtract the $240,000 adjusted basis from the $550,000 sale price, your actual realized gain drops from $400,000 down to $310,000. Next, you apply your $250,000 Section 121 exclusion. Subtracting $250,000 from $310,000 leaves a remaining taxable gain of just $60,000 instead of $150,000. If you also factor in closing costs and real estate broker sales commissions, which average 5 to 6% of the sale price, another $33,000 is deducted from the gain, bringing your final taxable gain down to just $27,000. By simply maintaining documentation of improvements and closing expenses, you reduce your tax liability from $30,000 down to a negligible fraction, keeping tens of thousands of extra dollars in cash. Now let us move to rule number 3, the step-up in basis rule for inherited property and surviving joint owners. If a senior inherits a home or holds property in joint tenancy with a deceased spouse, tax law provides an extraordinary valuation reset known as a step-up in basis under Internal Revenue Code Section 1014. When a property owner passes away, the tax basis of the property is automatically adjusted upward to its fair market value on the exact date of the owner's death. In community property states like California, Texas, Washington, Arizona, Nevada, and others, a surviving spouse receives a full double step-up in basis upon the death of the first spouse. This means the entire tax basis of the family home resets to current market value immediately. If a couple bought a home in California for $100,000 and the husband passes away when the home is worth $700,000, the wife's new tax basis instantly steps up to $700,000. If she sells the home shortly thereafter for $700,000, her capital gain is exactly $0, resulting in zero capital gains tax owed regardless of Section 121. In common law states, a surviving spouse receives a 50% step-up in basis on jointly owned property, still significantly reducing potential gains. Understanding how to properly document date-of-death appraisals prevents surviving spouses from paying massive taxes on gains that occurred prior to their partner's passing. To guarantee you claim these exclusions and basis adjustments without making administrative errors, you must communicate effectively with your CPA, tax preparer, or escrow officer. Here is the exact, word-for-word spoken script you should read when calling your certified public accountant or tax preparation office prior to closing your home sale. Hello, my name is Vorsh, and I am calling regarding the upcoming sale of my primary residence located at your property address. I am over age 60 and have owned and lived in this home as my principal residence for consecutive years. I am calling to ensure we properly apply the Internal Revenue Code Section 121 exclusion of up to $250,000 or $500,000 on my tax return using Form 8949 and Schedule D. Furthermore, I have compiled closing settlement statements and documentation for long-term capital improvements to calculate my adjusted cost basis, and I need you to review these documents so we report zero taxable capital gain. Me vi down, me vi down, me vi down, me vi down, me vi down. If you are a widow or widower selling a home within 2 years of your spouse's death, read this exact verbatim script to your CPA. Hello, I am calling to discuss the tax reporting for the sale of my primary home at URSEF. My spouse passed away on 2, which is within the 2-year surviving spouse window under Section 121. I am calling to confirm that we are claiming the full $500,000 joint exclusion on my tax return, along with applying the date of death step-up in basis adjustment under Section 1014 for my spouse's half of the property so that my taxable capital gain is completely eliminated. And let us summarize the vital action steps you must take right now. First, locate your original purchase documents, including your HUD-1 settlement statement or closing disclosure form from when you originally bought the home. Second, search through your home records and gather all receipts, invoices, bank statements, and canceled checks for major capital improvements made over the years. Third, if you are a surviving spouse, request a formal date of death appraisal from a licensed real estate appraiser to establish your stepped-up basis under Section 1014. Fourth, schedule a consultation with a qualified tax professional before you list or sell your property using the exact phone scripts provided in this broadcast. Never assume that real estate closing companies or tax software will automatically minimize your home sale taxes. The IRS requires proactive reporting on Form 8949 and Schedule D to legally shield your equity. By taking charge of your cost basis tracking, claiming your Section 121 exclusion, and applying step-up rules, you preserve the wealth you spent decades accumulating. Make those calls, compile your records, protect your home equity, and keep your hard-earned profits right where it belongs, in your bank account.